everybody, Chuck Barone here. It's Monday, July the 10th, 2023, and here we are for another week of crazy in this United States stock market, financial world, economy, whatever. Anyway, before we get rolling, let me welcome everybody to the show. As always, thank you guys for your support. You guys staying with us and watching these videos and all you do. It's what keeps the show on, guys. We appreciate you. All right, so let's look at these markets here. Today's kind of a weird day. We know last week did not finish well, right? Thank you, ADP. Although Friday's true jobs report was a laugher, right? Compared to what their prediction was. But today the market's kind of settling down a little bit, understanding the world we're in, starting to focus a little bit more now on earnings, which is going to be earnings season starting to roll in here. And so it's going to be interesting to see how this market holds up, whether the emphasis goes to what's really important in the stock market, are companies earning money, or inflation fears and down the road stuff as the market tries to anticipate the future rather than playing what's actually happening right now in the market, right? So anyway, markets solidifying a little bit today, rally a little bit. The Dow up 209, 33,944 on the Dow. The S&P up just 10 points. 4,409 on the S&P, the NASDAQ up 24 points, 13,685 for the NASDAQ. So not a big eventful day in the markets. Markets kind of holding their breath now. We know we got big inflation numbers coming later this week. We're going to get a ton of earnings and important data. It's going to give us real clear evidence of where we're going with this inflation fight. How are we doing so far? What can we anticipate going forward from the Fed? This is all stuff that spooks the market like crazy. The market would rather get bad news than have uncertainty, right? So the market digesting this higher for longer rate scenario and still up today because it's about earnings, guys, right? Bond market today, well, market actually rallies a little bit. Yields coming down. The 10-year down 4 basis points, sitting at 4% exactly. The 2-year coming down 7 basis points, sitting at 4.86%. This is kind of surprising because that inversion had been widening pretty dramatically, around 110 basis points, now down to 86. So a little bit of a contraction there, not much. Still a big inversion, still showing that recession, at least warning recession, possible, probable, coming soon. So the bond market, a little bit of a rally today. Decent for good news for guys like me who are interest rate sensitive in real estate, would like to see these mortgage rates come down a little bit. The dollar today, the dollar continuing its slide. Down, not big today, but down to 101.96 on the index. So breaking under 102. Was just up over 103 late last week. So the dollar, not, I mean, it's probably going to go back up, guys. Metals today up very small, not a non-event today in any of these markets really. Gold up 70 cents, 1,925 and 10 cents for an ounce of gold. Silver up 5 cents, $23.11 for an ounce of silver. So gold and silver holding their own with their prices. Would like to see the prices a little bit higher, and will likely see those prices higher. We got so much. These markets are trading on stuff today that is not really truth-driven. It's speculation, especially gambling on, now you got the Fed and interest rates and all these different things you can bet on, and then you can bet on how those bets will make the market react, and just they're piling it on, man. The casino is rolling, guys, right? Oil today down small, down 68 cents a barrel, $73.18 for a barrel of West Texas Intermediate. Right in that pocket where we expect it to be. So anything that happens between 70 and 75 is really not a big deal. It's the breakouts we're looking for. Is it going to break out higher or lower, and can it sustain it, right? Bitcoin today up again today. Bitcoin's holding its own, man. Up $646, 30,889. And I've been telling you guys, if they start these exchange traded funds, Blackstone or BlackRock, whichever of the Stone Rocks is doing it, and Fidelity and a couple other companies applying, it's going to create some demand for Bitcoin, and you're going to see a pretty nice jump here. So if you're a crypto player, I think you got reason to be happy if you're holding Bitcoin. All right, so as we do every Monday, let's look at what we're going to be getting this week. Data stuff coming in. It's going to be a crazy week, guys. A lot of interesting stuff going to be happening. Today we get data on consumer credit. It's kind of a surprise too, guys. Consumer credit falling. Consumers only adding $7.2 billion in debt last month versus over $20 billion in May. So consumers tightening things up a little bit. You know, we know a lot of this money is, you know, cars. Cars are very expensive, but credit card debt's continuing to rise as well. But consumers, at least, even though the debt is rising, it's not rising. It's only rising at, you know, less than 2% at this number. So that is kind of a better looking figure than the usual ones we're getting. So maybe consumers, either they're maxing out those cards or they're seeing payments jump they know are unsustainable. So consumers pulling back a little bit on whipping out the charge cards last month, right? Let's see, what else do I have here? Oh yeah. Oh, so here we go. Tomorrow we'll get zipped. Nothing really, no major news, at least that I've been made aware of, out of the Wall Street Journal today. Wednesday, going to be a big day. We're going to get CPI numbers. We're going to get the Mortgage Bankers Index. Now for CPI this month, it's going to be interesting because they're expecting the top line CPI to come in at 3.1%. That would be down from 4% last month, which would be a pretty significant drop. Core inflation, however, is expected to come in at 5%. And that's down from 5.3% last month. So top line inflation seems to be coming down pretty strongly. Core inflation, that includes food and energy, two of the everydays Americans got to have, a little more stubborn, not coming down as easily as some of the more expensive stuff, computers and, you know, durable goods coming down. So it's gonna be an interesting day on Wednesday to see those numbers. Do they come in? How does the market react to the numbers that do come in? We'll also get the Mortgage Bankers report on Wednesday, which is expected to be up. Go figure. So mortgage bankers, happy guys right now. On Thursday, we'll get the couple of big pieces of data. We'll get the PPI numbers. This is the foreshadowing to CPI, the Producer Price Index. Producer prices rise. They're going to pass those increases along to their retailers, and that's going to push consumer prices higher, the CPI numbers. So PPI always very important the way I watch the markets. PPI is expected to be up this month, not down. So we'll see where those numbers come in. We'll also get jobless claims on Thursday. Jobless claims expected to come in at 245 this week, down from 248 last week. So job market staying kind of warm. I wouldn't say hot anymore, but warm for sure. We'll see where those numbers come in. And then Friday, a couple quick pieces of data. We'll get the Import Price Index. Import prices really expecting to come in flat this month, which will be interesting and will help our inflation numbers. And we'll also get the University of Michigan Consumer Sentiment Index, which is expected to be up. I guess consumers, I was reading about that. They said the New York Fed reporting that consumers they're surveying really expecting inflation kind of just to go away pretty quickly. Their idea of where inflation is going to be in a year dramatically coming down from where it was at the start of this inflation cycle here. All right, so let's talk about news today. First thing I'm going to do is circle back to that ADP report. I wasn't able to get a video up on Friday. Every once in a while, my real job calls me, guys, sorry. But the numbers came in, 209,000 actual jobs created last month, when ADP had predicted 497,000, completely freaking the markets out. I kind of thought that number was going to be a little bit high and said so in the show on Thursday. 209 is a pretty colossal miss from 497. I mean, truth of the matter is, if I'm an economist and I turn in work that misses by that bad, I'm probably fired. If I'm hiring an economist and he turns in work that misses that bad, I know I'm firing that guy. So yay ADP, thanks for freaking everybody out for a couple of days and spooking this market. Now it's going to take us a couple of weeks to recover from it. Thank you, ADP. All right, so I saw a couple little quick blurbs today, right? The national debt, since our buddies in Washington have corrected their debt ceiling woes, right? So now they fixed it where they can borrow. Guess what? The national debt has increased by $1 trillion in the last 30 days. I was telling you they're going to need to borrow $1.8 trillion by August. Well, guess what? They're already past more than halfway there. The national debt now standing at $32.47 trillion, up $1 trillion in the last 30 days. A sick and sad number. Also read today, 57% of consumers, 57% of the people in this country, now living paycheck to paycheck, no savings, got to have that paycheck or they're toast. Another very sad, sad statistic. Commercial real estate, I've been talking about that. I tell you, that's going to be the catalyst that leads us to this recession or worse. I was reading an interesting article today. I was telling you guys, I have been telling you, that now it's institutions, not mom and pop, that are turning properties back into these banks. Just walking away rather than trying to make payments or refi. So today I was reading a Dallas, Texas company, Ashford Hospitality Trust, will return they're a big group that owns a whole bunch of hotels all around the country, and they're going to return 19 hotels to their lenders. These hotels are all around the country, Vegas and Texas and California. These properties would have required a $300 million in paydowns and improvements to keep them going. So the company, rather than pay out $300 million, just walking away. And I got a funny feeling, guys, this is the tip of the iceberg. This, we've already seen BlackRock walking away from real estate. Starwood's, giant industrial real estate, commercial real estate companies walking away from properties, and big ones, the biggest mall operator in San Francisco, walking away from the mall. I mean, this is just the start now, but it's like we talk about the snowball rolling down the hill. Now it's starting to gain some steam, starting to grow. This is going to be something tough. The Fed already coming out with new proposals for bank regulations on bank reserves. Right now, the regionals, the smaller banks, not participating in those stress tests, not participating in those regulations. Now they're talking about expanding the bank regulations to the regionals and smaller mid-sized banks. Going to put a lot of pressure on those banks, but they're looking at billions and billions of dollars in losses. Banks are not prepared to accommodate 19 hotels. What the hell are they going to do? They have no idea how to operate one, especially at a profit. They have no idea how to sell one, especially at a profit. It's a calamity coming soon. Alarm bells ringing. You can see the meteor in the sky, guys. You can see it. And it's just a matter now of where it hits and how hard, how big. Commercial real estate going to lead the recession. Anyway, that's it for the day, guys. It's Monday. Not a lot to report. We'll be back tomorrow. Look, tomorrow will be probably another quiet day. We'll start up the party on Wednesday with those CPI numbers and finish through the week. We'll be back tomorrow to bring you guys the news you need. As always, we appreciate your support. If you like what you're hearing, please hit the like button, guys. It helps us. Changes the algorithms around on YouTube, gets our video in front of more viewers. Always, of course, ask your questions in the comments. We'll be back tomorrow to give you guys the news you need. Until then, guys, take care. Thanks.